The financial storm in Washington. A financial storm is brewing in Washington, and this time, it's not sparked by Beijing's military or cyber operations. Instead, it's coming from the bond market. In just 72 hours, Treasury yields surged past 4.5%, foreign buyers pulled out of Treasury auctions, and panic spread from Wall Street to Singapore. The White House's quiet rollback on China tariffs. Then, without warning, the White House reversed course on China tariffs. No press conference, no public negotiations. Just a quiet rollback. Why? Beijing was rumored to be preparing a far more destabilizing move, a Treasury sell-off. The signs of trouble. If you think that's speculation, the signs are already there. On April 9th, the White House suddenly removed electronics, machinery, and EV components from the tariff list. Officially, it was to shield American families from inflation. But behind the scenes, sources told Bloomberg that pressure came from a 28% drop in foreign participation at Treasury auctions. Just days before, the yield on the 10-year Treasury hit 4.5%, dangerously close to the 5% threshold that triggered last year's banking sector turmoil. The bond narrative is out of control. Treasury Secretary Janet Yellen reportedly held an emergency call with Beijing's diplomatic team, coinciding with the tariff rollback. According to J.P. Morgan's Phoebe White, the administration lost control of the bond narrative. When Treasury's panic policy was announced, the public saw a press release, but the bond market saw surrender. Japan's defensive move. Japan acted first. In February 2025, Tokyo sold $36.6 billion in U.S. Treasuries, its largest one-month sale in over a decade. This wasn't an ideological move, it was defensive. With Japan's central bank abandoning yield curve control, Japanese institutions sold U.S. debt to stabilize domestic bond markets and protect the yen. China's silent threat. If Japan, a U.S. ally, is unloading treasuries, how should markets interpret China's silence? As of March 2025, China's holdings of U.S. debt stood at $775 billion, down over 30% since 2018. While Beijing hasn't launched a sell-off yet, it doesn't need to. According to Barclays' AJ Rajayaka, China's weapon is the threat, not the sale. The financial gun is loaded. No one knows if China will pull the trigger. If you found this video insightful, don't forget to hit that subscribe button. Stay tuned for more updates and content. We've got plenty more coming your way. The 5% yield problem. A 5% yield on the 10-year Treasury is unsustainable. On March 27, 2025, the yield briefly hit 4.96%, causing credit markets to seize. Mortgage rates spiked above 7.8%, and regional bank stocks plunged by an average of 6.2%, according to Goldman Sachs. The dollar's decline. The dollar index dropped 3.8% since January, and central banks from Brazil to the UAE are diversifying into euros and yuan while trimming dollar holdings. In March 2025, the IMF reported global dollar reserves at 57.1%, the lowest in nearly 30 years. HSBC's Max Keir stated, "The dollar is no longer the automatic safe haven, it's a volatility amplifier." Apple's strategic moves in China. Apple still relies heavily on China, with over 60% of its global assembly done there, and nearly 95% of its silicon packaging routed through Jiangsu and Guangdong. Tim Cook's February 2025 visit to Beijing wasn't ceremonial, it was transactional. Insiders report that Cook used Apple's leverage in China to warn U.S. policymakers that a full decoupling could cost $21 billion in relocation and delay the 2025 product line. The bottom line. The truth is, some American companies are too entrenched in China to untangle without significant cost. What do you think about this case? Drop your thought in the comment and do not forget to like, share, and subscribe.